have a lot of fun here. We're going to talk about a bunch of different things around stablecoins and kind of our thoughts around this. And so, yeah, I'm super excited for this one. This should be very good. I've got a general structure for how I want to kind of conduct this conversation. But I guess before we start, it would be nice to kind of make sure that everyone in the audience is kind of kept up to speed on all of the stuff that we're going to chat about in today's panel. So let's see. So I guess is there a way we could get some audience participation? I guess we're live on Periscope. Let me see. Okay, cool. All right, never mind. So I guess we'll start this one off by maybe talking about the outline for this chat and some thoughts I had around this. So the first thing I want to kind of bring up is that by the end of this conversation, I want the audience to have a clear idea of one, what DeFi is, two, what a stablecoin is, three, some types of the stablecoins that exist in the current market, and their roles within DeFi. Then we're going to roll the conversation in talking a bit about banks and base monies. Then we're going to dive into Trust Token, TrueUSD, MetaCoin, and Ample. Talk about some of the problems you guys are solving, how your systems work, and how folks can get involved and start using your projects today. So without further ado, I'd love to do a quick round of introductions of the amazing guests that we have on today's show. Maybe we can start off with Stefan, talking a bit about MetaCoin.
Sure. So I'm Stefan. I'm a blockchain developer, and I'm not just working on MetaCoin. I'm actually working on two projects. One of them is a new primitive for DeFi called Reflex Bonds, and the other one is actually MetaCoin that we might talk about today, but I'll just focus today on Reflex Bonds and some other time on MetaCoin.
Fantastic. Thank you so much. Then I'm going to jump this over to Evan at Ampleforth.
Hey, thanks. Yeah, my name's Evan. I work on Ampleforth, and the Ample is it's a DeFi primitive as well. It's kind of like a new money that's designed to move differently in the marketplace, adapt to economic shocks, and be less correlated with existing assets today.
Fantastic. Then I'm going to throw this to Raphael to talk a bit about Trust Token.
Hey, so I'm Raphael, one of the co-founders of Trust Token, and we're the makers of TrueUSD, which some of the listeners here may have used before. It's one of the major stable coins. We've got about 130 million TrueUSD in circulation today, and it's used on a lot of the major exchanges, Binance, Huobi, OKX. And more recently, we actually added 4 other stablecoin products: True Hong Kong dollar, Canadian dollar, Australian dollar, and British pound.
Fantastic. Thank you so much for the intros. I think we can all agree that we have a phenomenal panel here. There's a lot of really smart minds in this room, and so I'm incredibly excited to have this conversation today. Awesome. Great. So as I mentioned at the top of the conversation, there's kind of a general kind of structure of this conversation that I'd like to have. And the part of the reason why I put this together is that there's a lot of folks in here, some of which are super duper experts and understand this field in immense detail. And there are other folks who have perhaps maybe stumbled across this live stream and have no idea what a stablecoin is, what DeFi is, and all of this stuff. And so I'd like to kind of start off the conversation with a bit of light touch, kind of high level, and then kind of go deeper as we progress forward. So I think the natural place to start is DeFi, decentralized finance. There are many different ways people can kind of describe decentralized finance and its role within crypto. And so maybe I thought you guys could start off by talking to us a bit about what DeFi is and your thoughts around this. So I'm going to throw this to Evan at Ampleforth, and then we can go all the way around and share thoughts.
Sure. Thanks, Abel. Yeah, so decentralized finance, DeFi, is kind of this movement to create an alternative financial infrastructure that, in my opinion, just is designed to live beyond the reach of politics, right? So it's meant to give access to people who otherwise wouldn't have access to certain types of derivatives. And it's also kind of a little bit of an innovative playground for how to design new sorts of instruments. But I think the key thing here is that it exists outside the traditional system and exists beyond the reach of politics. And that's kind of the intention there. Now, I'd say that as a trajectory, one of the main concerns behind DeFi as it starts to grow is like, well, is it becoming increasingly centralized? Is it becoming increasingly censorable? And is that bad? Is that okay? Is that part of a natural evolution, or does it kind of defeat the purpose of this alternate financial ecosystem altogether? And I'm guessing we'll kind of touch on some of those points again throughout the conversation, but that's kind of just how I frame it.
Awesome. We definitely are going to touch on those things. There's a lot of time that we have, and a lot of different topics we can touch on. So yeah, that was a very good breakdown. Raphael, do you have any kind of additional thoughts on what we've just spoken about?
Yeah, well, I think that there's an interesting distinction between companies and projects that are trying to skirt around politics and regulations versus ones that are trying to comply with laws and regulations, but use blockchains and DeFi technology to be more transparent for their users. So, on protocols like Compound, DYDX, Nuo, and so on, you can see how much they've loaned out, you can see their collateralization ratios, and so that transparency breeds more trust with users, and that is a perpendicular advantage that is not predicated on them having to skirt around regulation. So I wouldn't see that, Evan, as being a necessary component for something to be decentralized finance. I think it's one approach.
Fair enough.
Yeah, this is part of why I am really excited for this panel, because there's kind of different thoughts around how we view certain things like decentralized finance, stablecoins, and many other things within the crypto scene. So I think this is going to make for a fantastic conversation. I throw this to you, Stefan, now. If you want to make some comments, do you have any additional thoughts on some of the stuff we just spoke about?
I would add a bit to what Evan said, and maybe say that DeFi is and should ideally be in the future controlled by robots, whereas the normal traditional finance ecosystem is controlled by humans.
I love it.
That's interesting to see it.
But yeah, I think the key is like the operative word here is decentralized finance. So if we wanted it to be open finance or algorithmic finance, we could call it that. So it is a big question in my mind. It's like, why is it decentralized finance? Why are people excited about that? What need is there for decentralization? Is it just to be more transparent? Is it to gain more trust? Do we need that much more trust? Do we gain actually effectively more trust by not having regulations? Do we allow regulators to censor more carefully because it's on an open ledger, or truthfully? I think a big part of this hinges around why we're calling it decentralized finance. And just kind of as I see it, things are decentralized because you don't want a central authority controlling things. So perhaps there's a robot controlling something instead of a central authority, but really you can have algorithmic finance that's controlled by a robot that's not decentralized as well. And you could have open finance, I think, or programmable money without it existing on a blockchain or being decentralized. So I think a big part of being decentralized is being something that no central authority can control. And I think the mandate of decentralized finance is kind of similar to the mandate for the creation of an independent money. So, there's no nation state, so to speak. There are no people, right, that are governed by a body of rules or central authority. Decentralized finance doesn't have to worry about the Fed mandates like maximizing employment or maintaining stable prices or upholding long-term interest rates. It doesn't have to worry about those trade-offs because there are no people to optimize employment rates for. And so it does have kind of this different purpose than the central banking system and centralized finance systems. And I think that its purpose is to create more optionality so that it can play some competitive pressure against centralized monopolies so that there can be a natural evolution here. Now, I don't think that its role is necessarily to replace centralized systems. Perhaps, as Stefan was saying, it could one day do that. But I think really it's about creating more optionality for people who don't have access or a little bit of competitive pressure for central planning systems that may not be completely efficient.
Right. And so in that context, there's kind of different ways to view the term stablecoin and kind of the objective of what it the objective of something like this. And so I'd like to kind of switch the conversation into discussing a bit about stablecoins, right? So, maybe we could have Stefan talk to us a bit about what a stablecoin is, and then again we'll go around and we'll do the same thing and have each other speak about how we interpret it.
Well, it's a bit unfortunate that most people today associate stablecoins with pegged coins. That wasn't the case a couple of years ago. The idea was that a stablecoin should have been a low volatility kind of proxy for a certain collateral type that you use in creating that stablecoin. And that was the initial idea when DAI was initially created on paper. But then it's changed because people wanted pegged coins. And now recently we saw that the government, and all governments around the world want to ban stablecoins, even the supposedly decentralized ones. So we might need to change the narrative.
Well, I think that pegged coins is somewhat just the product that people want, because if you're trading a stablecoin for Bitcoin, people think of the price of Bitcoin in terms of US dollars, and people think of most products in terms of US dollars or another fiat currency like euros or yen. And so I think that in a competitive market, it's going to be the pegged coins that most users are going to choose, and that's what we've seen over the last couple of years.
Yeah, I totally agree.
We don't yet have the other alternative, which I'm trying to build.
Well, people have some other alternatives.
Yeah, if I might interject for a second, I think there was a moment, at the end of 2017, Tether had already become this dominant trading pair token, right? So they kicked it all off by just collateralizing a bunch of dollars and servicing exchanges. Ultimately, people wanted to trade Bitcoin. They wanted to speculate on the potential for price appreciation that Bitcoin had. And in order to do so, they needed to quickly move in and out of US dollars, right, to avoid volatility, to move money around. And Tether really kind of lifted the gates on that by creating the coin that they did, and grew to a very substantial market cap and was circulating at a high velocity. There was a moment where we all felt as though it was a single point of failure, it being the only such instrument. And everybody was terrified that it could collapse, right? Because it wasn't very auditable. And so suddenly there was this new influx of stablecoin projects that were designed to diversify away from Tether, just almost to provide an equivalent service, right? So that we can move in and out of, Bitcoin and ETH. And so we saw a lot of stable coins that were fully collateralized start to succeed and fill that role, and you're one of them. But largely, we've been wrong about Tether falling apart. So it's grown to a massive market cap, and it still is servicing, the entire industry. Binance only exists because Tether allowed it to, avoid having to have a banking relationship out the gate. I'm very glad that it's not the only solution that's being offered, but yeah, that did kind of become what a stablecoin was, a replacement for Tether. But if you just roll back a few more years, back in 2014, at this time there was largely only Bitcoin trading, and folks were always talking about this holy grail of crypto. Like, could we create a equivalent to Bitcoin that was as decentralized and that was non-collateralized and algorithmic, that could also fulfill this additional function of money of having some measure of price stability? Because without that, Bitcoin would always just be this kind of digital gold. It would never actually evolve to become a widely used media of exchange. And so they referred to a stablecoin back in 2014 as kind of the holy grail of crypto. So we went through this transition of originally describing a stablecoin as this holy grail of crypto, like the alternative to Bitcoin, except for it could be stable, in some way, to kind of a substitute for a collateralized dollar, which was like, let's diverse away from a single point of failure with Tether, and have kind of regulated banking partners that allow people to kind of move in and out of dollars on the blockchain. And so it took on this dual meaning, and that's kind of why I really don't even like the use of the phrase altogether. At the end of the day, one of these things is a bank, right? It has assets and liabilities. Tether's a bank. It accepts deposits, it feels withdrawals. It's in what they call an inside money, to be kind of differentiated from something called an outside money that is never collateralized. So in the example of the US dollar banking system, the outside money is kind of the paper money, right? And the inside money is kind of the credit-based relationships that's created and it represents such a large portion of the market cap. So yeah, I mean, I really am not a huge fan of the phrase because you can't simultaneously be describing like the holy grail of crypto and Tether with the same phrase. So I think we would hope that we could move beyond it, and there really is a need for many of these things up and down the chain. But that's just kind of my opinion.
It's interesting you bring that up because I think you're right in that there's a lot of confusion around this term.
Sure.
So maybe it might be a good idea to kind of step back a bit and talk about the lay of the land, the actual kind of the landscape of all of this stuff. So I have like a general structure, and obviously we can discuss this. But maybe I was thinking we could talk a bit about fiat collateralized IOU type stablecoins. And then we can talk a bit about crypto collateralized stablecoins, and then the non-collateralized stablecoins, and then bring the conversation towards some of the points you made, Evan, in that we need to make a clear distinction around banks and monies and all of this terminology. So let's kick it off with fiat collateralized IOU stablecoins. So things like Tether, like you mentioned, Trust Token, Circle, Coinbase, USDC. And we have an expert in the room from Trust Token, so maybe Raphael, you could take us on a journey of like what it is and the pros and cons and some of the risks.
Yeah, absolutely. So fiat-backed stablecoin like TrueUSD, it's a very simple model. So with TrueUSD, you can go to our website, you create an account, you send in, let's say, a $10,000 bank wire, and then we'll mint for you 10,000 new TrueUSD. You can send in 10,000 TrueUSD, and we'll send you a $10,000 bank wire. And all the money is held by our banking partners, which are banks or trust companies either in the United States or abroad to help service some of our international clients. And that's the model that we use, pretty similar to the model that's used by USDC and by Paxos. I think Tether's banking situation is a bit different, and the regulatory situation is a bit different. But the model for TrueUSD, Paxos, and USDC is all fairly similar. So the biggest advantage, I think the reason why this category of stablecoins has the majority of market share, even over products like DAI, which are excellent products and have a lot of benefits, is that people don't just want a price stable cryptocurrency. They want to be able to move in and out with fiat currency, like US dollars. And if you have something that's actually backed by US dollars 1-for-1, and you can go redeem it any time for US dollars, that's really convenient. And traders and exchanges and many other players really like that. Whereas as soon as you leave the fiat-backed model, you have to cross a market, you cross a spread, anytime you want to move that back to US dollars, back to fiat currency.
I love it. And just sticking with this topic, what are some of the, you mentioned some of the pros there, and you mentioned some of the kind of the benefits of all of this good stuff. What are some of the cons and some risks around this? Because I know it's probably, if I could think about it as a spectrum, it's probably on the less riskier side, but there obviously still are some risks there. So could you please kind of describe some of those?
Yeah, so it's simpler than other systems like crypto collateralized stablecoins or uncollateralized stablecoins from a technical perspective, but it does add certain counterparty and regulatory risks. So, all the US dollars, about 130 million US dollars that are backing the 130 million True USD in circulation today, and those are held by our banking partners in FDIC insured accounts. But if those banks were to go under, or that some sort of fraud were to happen, then the True USD token holders are ultimately trusting those banks, to still be able to provide the US dollars for redemptions. So that is the sense in which it's more centralized than something like a DAI or a purely algorithmic stablecoin.
Yeah, and I think it's interesting because the reason why I kind of wanted to bring this topic up is to kind of give the lay of the land, right? To be able to kind of teach the people in the audience that there's a spectrum here, and there's different kind of things that fit within that spectrum, and kind of showing them how this would work. And obviously, things like Trust Token and TrueUSD fits within that spectrum, slightly less risky than other kind of potential solutions, but also has its kind of positives and negatives. So it's a good kind of way of describing this. So thank you so much for that. I appreciate that, and hopefully that's given the audience some idea of like one side of the spectrum. I want to kind of switch to the other side of the spectrum, which is crypto collateralized stablecoins. Things like MakerDAO and DAI. Maybe Stefan, you could take this one and tell us a bit about what it is, pros and cons, of some of the risks around it.
So the idea of DAI is that it, in a way, inherits the moneyness of ETH or other collateral that it has in the system. It's in a way it's kind of stable ETH, but the problem and the advantage with DAI is that it tries really hard to stay close to one peg, close to a fixed value, and we've seen in the past couple of weeks that this doesn't really work in some scenarios, and kind of the system is broken. That's kind of the less than ideal part. The good part is that similar to true USD, people can expect that DAI will be close to the dollar at least over the short term, and they can trade it between Ether and other crypto assets on exchanges. I think these are the main pros and cons.
Yeah, if I might add, like just kind of putting these pieces together, I kind of agree with what you guys have been saying. So there are kind of a couple forces at play. One is, people need to move their fiat money onto cryptocurrency exchanges. They want to trade and speculate on things like Bitcoin and ETH. Therefore, they need things like, Tether, True USD, USDC. DAI is more ideologically driven, where it's meant to be decentralized. Just because it wants to put some sort of, in a hopeful future, it would theoretically want to put some sort of competitive pressure against things like the US dollar as a widely used media of exchange. I kind of think that that's, getting way ahead of ourselves. But there's this other movement going on in general where we have these smart contract platforms like Ethereum, right, where you can write these kind of programs that hold things in escrow and automatically execute transactions. In order for those smart contracts to work, they need to interface with monies that are part of that blockchain ecosystem, like ERC20 tokens. And by having some collateralized fiat or things like DAI on those ecosystems, you can now start to experiment and program and develop new instruments. And we see things being created like decentralized exchanges like Uniswap. You see kind of these lending platforms like Compound and so on and so forth. But really, the heart of that is knowing at some level that it's not censorable. So if it were simply programmable, but fully censorable, I don't think people would necessarily be doing that on Ethereum and only Ethereum. Like, for example, in India, you see kind of widely adopted programmable open banking APIs, right? So pretty much everything you could imagine, programmers wanting to do with money can be done in a regulated system. So at some point, the ethos of this entire movement is about, can it be done in a decentralized manner? And that's why it was such a blow to the community that, DAI started to fall apart, because we can still do everything we need to do with like USDC and True USD, but you just don't feel as good about, things like Uniswap depending on a central authority in order to provide this so-called decentralized exchange. And so it kind of feels like there's just a hole that needs to be filled. So that's why it's, it's interesting and valuable to the community that people like Stefan are kind of stepping in to create alternatives to Maker. My kind of perspective is a little bit different. So, just to refresh here, like the Ample isn't actually a stable coin. So it has a price target, but it has all these other interesting properties to it. It's designed to just be less correlated, right, with the existing ecosystem. And most importantly, it's highly volatile. So it's weird that we get grouped with stable coins at all. But I'm happy to talk about it always, because part of creating stability in kind of a basket of assets is a different kind of volatility. So if everything's moving up and down in exactly the same manner, you can't, reduce the aggregate volatility for portfolio by adding additional assets, right? But if things are moving slightly differently, then you can begin to diversify risk and reduce aggregate volatility with a basket of decentralized assets, so to speak. But yeah, I actually see things like Ample fitting into one of three potential outcomes for crypto, only one of which is actually DeFi succeeding. So one potential outcome would be that crypto just remains speculative, right? It's kind of about value storage and value transfer, and it becomes something that's uncorrelated with traditional assets or disconnected from the traditional markets like Bitcoin that kind of just trades up and down, and people do that because they want to make money in a way that's slightly different or maybe profoundly different than traditional asset speculation. That's one potential outcome, no question, for crypto. We all have like Robinhood. It makes perfect sense for me to see Bitcoin next to my Apple stocks, right? Check in the morning, did it go up? Did it go down, right? Makes a little bit less sense to see Bitcoin in my Chase banking account or my Bank of America account or my Visa card where I'm like using it to transact for coffee. And for that matter, I have no problem transacting US dollars for coffee. It works fine. It's fast. It's accountable. I like it. If people steal my credit card, I can report that as fraud and it's insured, right? That's some of the assurances of being regulated and centralized that maybe Trust Token, TrueUSD can provide as well. These are huge benefits to being part of a centralized ecosystem. So there's this outcome where crypto becomes purely speculative. Amples fits in because it's just a different flavor of randomness, right? So it'd be used for diversification. It has the potential for price appreciation and loss as well. High risk, high reward, but just a different flavor of randomness. But if you put it into a basket with other things that are also moving up and down, though not in the exact same way, you can diversify and de-risk your aggregate portfolio. So then there's a potential outcome where like DeFi does become this alternative to financial infrastructure that's run by robots, or controlled by no one and fully decentralized. We still are going to need decentralized assets to become more stable. And at the end of the day, we're looking at kind of an ecosystem where all the assets move up and down in lockstep, something that would be considered extreme hypercorrelation by the standard of today's like equity markets. And if you don't want to rely on the collateralization of US dollars and you do want to remain truly decentralized, then we're going to need not just amples, but like a whole bunch of new assets, new monetary instruments that are fully decentralized that aren't just like Bitcoin. If you go down the list of actual pure monies in crypto right now, it sounds like there are thousands of coins. But if I'm talking about pure monies, right, and by this I just mean like digital assets that are not collateralized, that have no non-monetary utility, like you can't consume it for any reason, then you're looking at like Bitcoin, you're looking at like Litecoin, Bitcoin Cat, it's just a handful of forks. These are the pure monies out there.
Quick question: Why do you think it's crucial for it to be a pure money? Does having some kind of consumptive utility like Ether, does that necessarily make it worse as being a money?
Not necessarily. So at the end of the day, it kind of, without getting too much into it, there's this thing in Marxian economics called the Lego theory of value. And we always thought that like you had to commit some amount of time or effort into something in order for it to have value. And many of these commodities were encodings of that. Like you created a farm, you harvested some wheat that took time and effort, then became valuable, and we could store and transfer value with that, right? And then there are things like gold that have some sort of consumptive use case as well. It could be turned into jewelry. And there are things like oil, which are analogous to ETH, where it can be burned for fuel and for consumption as well, right? And the next level was, again, breaking free of that notion of use value. So fiat money was the first step into that. It was the first money we saw that was effective, that had no non-monetary utility. You can't make a house with fiat money. You can't eat it. You can't burn it for fuel. You certainly shouldn't be. And by the way, it wouldn't be better if it was the case, right? So if we could eat dollars and paper money, that wouldn't make it a better monetary instrument. It would just make it harder to regulate supply than it already is, right? And so, yes, when you introduce these consumptive use cases, you introduce demand distortions from that utility use case. Like, for example, with oil, it's a decent money, right? But all of a sudden there could be demand and supply shocks that are introduced by the waxing and waning of like demand for oil, demand for travel, sanctions on things like that, right? And so that starts to interfere with the purpose of money, which is actually not to be the value of the object, but basically be the media with which you kind of exchange value between objects. It's kind of supposed to be just invisible in that way. And so I think with things like Ether, they're becoming increasingly more similar to a natural commodity money like oil. And I think the coolest thing about Bitcoin is it has this kind of dual property of being a lot like fiat and also a lot like a commodity. So it's perfectly scarce, kind of like gold is absolutely scarce. And that's a quality that we typically attribute to like natural commodity monies, but also has no non-monetary use case, right? Just like fiat, right? And so really, if you're thinking about the evolution of money, stepping forward into having no consumptive value is better if you're talking about a pure money. Now, that doesn't make it better necessarily as an asset to hold. I would love to hold an asset that kind of goes up and down based on how much actual consumptive demand there is for it, like oil, right? And say there are many utility tokens that could potentially exist. Like say there's one for like, delivery coffee, or like Uber on the blockchain, Airbnb on the blockchain, file storage and stuff like that. But what you eventually come to see, if they started to tightly couple the connection between demand for the underlying utility and value for the coin, is you'd start to see it trade much more like a traditional asset. And you'd also start to see it trade in a much more tightly coupled way with demand patterns for coffee delivery at large, right? So if demand for coffee delivery is high in the blockchain world and in the centralized world, and value is going to go up, and demand is low, value is going to go down. So right now we don't even see that connection between demand for an underlying service and price appreciation for a coin, which is its own problem, right? We see utility coins and pure monies all just kind of mimicking the movement pattern of Bitcoin. But what I'm saying is, while it appears to be the case that there are thousands of cryptocurrencies, they all move identically, and so effectively there are very, very few, right? There are very few things that move differently. So there are things like TrueUSD and Tether and USDC, which move very differently than Bitcoin, because we understand that there's some quality to this underlying system, redeemability. I can redeem this token for $1 in a bank account, and therefore, if there's any kind of drift, that'll be arbitraged away by that redemption quality. And so it would make no sense to trade that like Bitcoin. But in the case of like utility tokens, like the thousands that I don't even want to name, but there's Bitcoin and there's ETH and there's Litecoin at least, right? You can just kind of trade it like Bitcoin, and there's no punishment for that whatsoever. And so people do, because it would be senseless to assume that's not going to move up and down with Bitcoin. And so we need to diversify away from a single movement pattern here, so that we can de-risk the aggregate volatility of these assets if we want to, one, kind of maximize reward, minimize risk, make the space grow kind of according to like portfolio construction, right? So if you want to have increasingly optimal, constructs here, you need more diversification. But we also need that if we want to one day create a programmable, decentralized finance alternative that doesn't rely on central banking partners. And then the last kind of potential outcome is like, it's possible that things like Bitcoin could one day be held in the reserves of central banks or central authorities, just like, gold is held in the reserves of like high net worth individuals and governments, right? So we could see that happening as well. But in all of those cases, I just think we do need to diversify away from this single movement pattern.
I just touching on that, I think that's a fantastic point, and like I think you outline it really well in that a lot of these assets in the crypto space kind of have this problem of hypercorrelation, and the fact that there isn't that much diversity allows for all of the issues that you're mentioning there. I think this conversation is kind of turning to a very interesting one, which is one around DeFi and how it needs better primitives. And so, Evan, you obviously done a great job there of kind of outlining some of your thoughts on all of this. Stefan, I know that you have some interesting thoughts on this too, so I'd love to hear yours, and then maybe you can throw it to Raphael to kind of add on top of what you say.
Maybe I can touch a bit on reflex bonds, because these are a reflex bond is basically a low volatility asset compared to its collateral. And when I mean low volatility, I mean that if ETH is used in backing the reflex bonds, in the short term, if the price of ETH tanks, the price of the bond will go up slightly, but on the long term, the price of the bond will follow ETH. Basically, a reflex bond is very similar to DAI in the short term. You can use it to store value in the short term, but in the long term, it will drift. The market, the price of the underlying collateral determined by the market will influence the reflex bond. So instead of keeping control over the system like Maker does, we want to allow the market to control this and offer the market an alternative to ETH that's still trustless, but it has lower volatility overall.
So
that's how I think some kind of decoupling can be done with reflex bonds.
Stefan, why do you see that in-between point as important? Because you've got something like DAI that's aiming to be fairly stable, ETH that's highly volatile, something like Reflex Bonds, where does it fit, and what do you see as the main use case?
I see it as a support layer for other DeFi protocols. So, for example, you don't want to use it to transfer value over the long term or store value like you would use Trust Token or USDC. You want to use it to offer other protocols dampened exposure to the crypto market. So instead of using ETH and being, for example, 50% down in one day with a Reflex Bond, you'd only be, let's say, up in the first day 5%, and then over the next 3 months, let's say, you'd be down 50%. So you have kind of a delay on the price of that bond, and this helps other people using the bond in other systems on Ethereum to hedge against this huge drop that happened a couple of weeks ago, for example.
Right, but you could alternatively just retreat into something like dollars as a hedge too, right?
Yes, but that's not
I could just sell into this fulfills a different purpose essentially, right?
Yeah, so it's not money as you framed it.
Okay.
It's a support value. It's a support layer for DeFi, for other people to create synthetics or whatever they want.
Right. So I would kind of describe that as almost a synthetic or a derivative. So the underlying collateral asset would be ETH, and through some arrangement of pre-programmed contracts, you've created this new derivative of ETH that kind of delays things, right? It's just a little bit different, right? A different flavor of randomness, if you will, but without the same kind of. Does it still have the same kind of potential reward profile as ETH? Could it appreciate 1,000x the way like Bitcoin once did and ETH once did and can still do?
So for example, let's say ETH tanks, the market price of the bond goes up now, but if ETH has sustained tanking, the bond will go alongside ETH. So yes, it will be kind of correlated, but over the long term, and you'll kind of see, if you use the bond, you'll kind of see, hey, ETH is going that way, so the bond will also go that way. But I have more time now to think, how do I exit this protocol? What do I do? Where do I go? And maybe now I want to go to Ample, or I want to go to USDC or whatever, but I have more time to do
yourself some time. Okay, cool.
Yes.
Yeah, I mean, I think this stuff is fascinating. So I think, again, the more we can diversify away from just one movement pattern, the better. I don't think our trading strategy should simply be risk on, risk off. You're either holding, Trust Token or any and every crypto. I think there should be a little bit more optionality there. I do have this question, I think, about these market-driven kind of systems where if your supply policy is dependent on kind of the behavior of profit-seeking actors in an alternate market, there is this kind of disconnect. And this is something I kind of wanted to run through with you, Stefan, because I'm more thinking in terms of DAI than Reflex Bonds at this moment, but I kind of wanted to ground my thoughts in this conversation with you. When I thought about DAI from the very beginning, I always thought it was deeply flawed from my perspective, because we've had a lot of consultation from our academic advisors at the Hoover Institute. These are people who have been thinking about money for decades, right? Like Friedman was at the Hoover Institute, right? When we looked at DAI from that perspective, which was, as you said, it was a collateralized dollar equivalent. It really, I think, had this fundamental flaw, multiple fundamental flaws, but it didn't have a tightly coupled loop between supply and demand. So if the demand for it was high, it's not as though the supply of DAI was increasing as a result of that. In fact, the supply of DAI might simply increase as a result of ETH skyrocketing, right? So if ETH went up, then all of a sudden, you're creating more DAI, right? If ETH goes down and everybody needs more DAI, you're not creating more DAI, and in fact, you're deleting DAI, right? And so it really felt as though that was fundamentally flawed. Maybe there's a solution in which when you need more DAI, there's a healthy incentive for market actors to create more of it. And maybe there's the alternate as well. When you need less DAI, there's a healthy incentive for market actors to do so, as determined by fee rates and interest rates and stuff like that. But we've seen that sort of thing break down in traditional marketplaces as well. So think about Venezuelan bonds, right? There's an incentive at some point to buy them because they're very cheap, but people aren't doing it, which is why it started to hyperinflate, right? So depending only on profit-seeking actors to create supply and destroy supply has already kind of failed in that regard, and it happens in repo markets as well. We just see this time and time again, where like there isn't really a tight coupling between supply for the underlying asset and or demand for the underlying asset and supply, that you want to run into liquidity issues again and again and again. And that's the beauty of the central banking system that we all know and love. It can actually, at its discretion, increase the money supply or decrease the money supply, and it can react to all sorts of economic shocks and phenomena, and it can bail others out, right? So the thing about these centralized ecosystems is they have sovereign authority, right? They can force you to pay your taxes and denominate that in your currency, and that's why central banking works as well as it does, right? So they can bail other entities out by increasing the money supply. And because a bunch of people are using that money, they're forced to pay wages and pay taxes using that money, there's this phenomena called like price stickiness. So there's this massive time delay between the moment they introduce a ton of money into the system to the moment that's actually reflected in prices and wages. And so they can do these sorts of things like stimulate the economy, bail others out. And so anytime you're designing a system that's meant to be independent, if its supply policy is dependent on a marketplace, a separate marketplace of profit-seeking actors, you're eventually going to run into some sort of liquidity crisis, thereby requiring a bailout, except you don't have sovereign authority, which means, the moment you do something people don't like, they can simply leave your money. That's the whole point, to create choice, right? And the downside of that is like you can't bail yourself out. Instead, you have to rely on private parties to bail you out. And so I think that's just a self-defeating concept in general. So if the mandate of an independent money is to apply some measure of pressure to centralized monies so that they can evolve, not necessarily replace them, but some measure of pressure, then a system like that eventually is going to require some sort of bailout and can't print money with sovereign authority seems deeply, not like, it's just flawed and unnecessary.
But Evan,
yeah,
I think that the same criticism could be said of fiat-backed currencies like True USD, True British Pound, and so on.
Now, in what way?
Well, so I mean, True USD, like, we don't have sovereign authority to arbitrarily print True USD with more demand. It does require a third party, like a market maker or other liquidity provider. They'll see that True USD is trading at $1.01 or $1.50 on exchanges. Then they'll just do an ARB, where they'll go.
Well, that's because you offer redeemability, though. So say True USD is trading at 50 cents. I know I can redeem it for $1, right?
That's right.
Right. So the knowledge of that redeemability is what makes that equilibrium work out well. But in the case of the bonds that I was talking about, like Argentinian bonds, repo markets, Venezuelan bonds, in the case of DAI, where it's like I can lower interest rates as much as I want or incentivize people to collateralize more of this or buy more of this asset, doesn't mean people are going to do it, right? Because there's no sovereign authority. And the redeemability is probably the problem. I can redeem it for ETH, right? But the ETH price is moving up and down also. We're talking about a very different situation. You guys are okay. I think you're fine, right? I'm much more worried about this. Like a non-fractional dollar collateralized bank, I think is fine. It's going to be regulated, but it's going to be fine. But things like, it's about expectation and reality. If you tell people this is going to be an alternative to True USD, except for it has this weird quality where there's this in-between marketplace that actually controls its supply and demand, that eventually is going to result in some sort of liquidity crisis, then you're just kind of, you're going to set people up for disappointment. I think the space has seen enough of that, and we should try to minimize that, right? So I try to be real about it and say that, look, largely people want to speculate on cryptocurrencies for price appreciation. What good could come of that? If Bitcoin is only ever a purely speculative asset and it's a fixed supply speculative asset, is that fulfilling any sort of ideological mandate that's worth considering? And I think the answer is yes, right? Because I don't think the idea here, I guess the kind of primary work on this mandate is kind of from Friedrich Hayek in the denationalization of money. So this was written in the 70s, and of course he was facing a situation of potential hyperinflation because we had just left Bretton Woods system, right? And so we're entering a situation of extreme inflation. And he's saying like, okay, we should just allow banks to issue their own money. And because if we do so, then people can choose which money to use. And it stands to reason that the most stable money would have continuous demand, right? Because we can avoid inflation. But in the last kind of decade, we've seen a lot of kind of capital or just like money enter the system, a lot of liquidity injection from central banks and the Fed and stuff like that. But we haven't seen a lot of inflation, right? What happened instead, right, was that when the banks lent people a bunch more money, they didn't, consume 1,000 times more food or purchase 1,000 times more TVs, and wasn't reflected in price changes, right? They instead decided to speculate on short-run assets and kicked off an asset bubble. So instead of that money resulting in increased inflation, it resulted in increased speculation and an exaggerated kind of boom and bust cycle. And I think so. Bitcoin fits in really nicely here because it's disconnected from the major forces at play. So much of the last decade has been about U.S.-China relations. Right? The entire global economy kind of revolved around that chimerica dynamic, right? Just to have access to an asset that sits outside of that ecosystem, right? That's not governed by the same kind of trade sanctions, right? That doesn't care about things like the cost of capital, cost of employment, forward-looking things like expected GDP growth rates and stuff like that. I think the power of Bitcoin is in, number one, its scarcity and its lack of connection to the traditional system, and so it can apply an interesting level of pressure. It's not applying pressure by replacing the dollar as a widely used medium of exchange, but it's applying pressure by giving you this option to store value in something that can't be pushed around by the same forces that push everything else around. And in a slightly indirect way, that'll force those parties, if it gets big enough, to just be a little bit more efficient. And it becomes a little bit of a self-regulating system in that way. And so I do think the actual mandate of an independent money like Bitcoin, as I was describing now, is to kind of provide optionality, reduce kind of exaggerated boom and bust cycles, and give people just this ability to store value in an asset that's disconnected from the traditional system, which is way too interconnected. And so by adding more diversity to this ecosystem with assets like Ample, which are effectively scarce, absolutely scarce and non-dilutive, but just a different flavor of randomness. It can appreciate. It's not like a low volatility token or anything like that. You can lose all your money or you can make profoundly more than all your money, just like with Bitcoin. It just moves differently. And that adds value to that simple mandate of creating optionality for people to kind of store in something that's disconnected from the traditional ecosystem. And now it also has the benefit of being something that in aggregate with other assets could be used to synthesize new instruments and maybe be kind of a building block for a new alternative financial ecosystem if that really starts to take hold in a big way. But my concern is like DeFi as it is right now is going to just work until it matters, right? So if it is not truly decentralized and it starts to actually work and interferes with, how banks feel like business should be done or central banks feel like monetary policy should be run, if it interferes with their jobs and they can shut you down, then they simply will, just like they have in the past, right? And so I'm not really sure whether it has legs unless it actually is decentralized. I'm not sure whether it's providing more access to people or applying pressure. So I talk about competitive pressure, but I also just mean providing access, right? So if people don't have banking services, they're in the developing world and they need access, and this is their way of getting access. That puts pressure on their central governments to give them better access, right? And so it's still all connected. So I don't really see that need there yet, and I don't see that it has legs in that regard in the developing world. And obviously, if I'm thinking about Maker, it's a three-sided marketplace. There's DAI, right? Is there demand for it as a widely used media of exchange? Not really. Is there demand to borrow so that I can take a leveraged trading position? Yeah, a little bit, but there are very, very healthy alternatives to that. I can trade on margin on a number of exchanges already. But there is demand for people to gain passive interest, right? Some sort of low leverage. There is demand that's kind of the hangover from ETH's fall in value, right? Bag holders who don't want to accept losses are sitting on ETH. They're not willing to kind of exit their position. What can I do with that ETH? Oh, I can stake it. I can collateralize it. I can get a little bit of leverage on it, right? I think that was a big part of what made DeFi kind of spark in the passive interest generation kind of angle. It's just the fact that people were sitting on losses that they didn't want to realize and wanted to do something with their assets. So there's a couple forces at play. So there's one, which is like, people want to speculate for that. USD makes sense. Ample makes sense because it has potential for price appreciation. That's random. Bitcoin makes sense. ETH makes sense, right? There's this need to have some sort of use case for smart contract platforms, right? And so collateralized dollars make sense in that regard. But for it to have legs in the long run, a decentralized equivalent also needs to exist. And there's this third force, which is people at some point lost a lot of money on crypto. They weren't willing to accept those losses, right? And they wanted to gain passive interest, and that became a simple way of bootstrapping some of these services well. But I don't know how long-lived that potential force is going to be unless the marketplaces are fully balanced. Like there needs to be just as much demand to borrow as there is to lend, and there needs to be just as much demand to kind of use things like DAI as a media of exchange or trading pair token as TrueUSD is used, as there is for it to kind of be this thing that happens to allow you to take a leverage position, but also allows you to generate some interest on your crypto holdings, right? So I think there's a lot of potential here, but we kind of need to shake off all the rust. Like, what are all the hangover thoughts that we had from 2017, right? Okay, we lost a lot of money. We want to kind of, do something about that. That will eventually pass, right? Things will reset. Or like Tether is falling apart. We need 1 million tethers. No, maybe we need like 5, right? Maybe we can't have 1, but we don't need 1 million of them, right? And then we need to take stock of what's left. Because I think that that will kind of give new clarity into what's worth kind of giving our attention to, because there are so few things that are worth giving our attention to. Just there's too much noise, too many false promises.
Evan, you'll be happy to know that kind of some of your concerns will be addressed in a future post that I have. So I have
That's awesome.
some ideas about making a pegged coin, and this is the MetaCoin angle.
Okay.
That's not always fixed and tries to kind of work on the problems that Maker has, but I'll give more details in a post. I'm better at writing than talking.
Dude, me too. Just send it over. I'd love to kind of think through it.
This is amazing. I'm loving this conversation. Like that kind of roundup of all the thoughts that you had there was super fascinating, and I have like a lot of follow-up questions on that. But before I get into that, Raphael, do you have any kind of comments on all the things that have been said from your perspective?
Well, I think Evan, what you said about they're building an alternative, and if they can shut you down, they will. There's a key question of do you make them want to shut you down? Because there is a sense in which stablecoins and DeFi are competitive to the existing financial system and the existing banking system. There's another sense in which they're highly complementary. And certain stablecoins like TrueUSD, we work with many banking partners in the US and abroad. We're compliant. We've been audited by them. And so we have very good relationships with banks and with auditors and regulators and so on. And so there's while it may be more centralized than other stable coins like DAI, there's less of a, there isn't necessarily the desire from banks and regulators to shut something like that down if it actually can ultimately be synergistic.
I think it can be synergistic. I just don't know that actually requires a blockchain. So it's more about the promise that was sold versus the promise that can be delivered, right? So I think a lot of value can be created by an open banking API system. I don't know that a lot of that requires a decentralized smart contract programming infrastructure. As I said, we've seen a lot of this stuff really take off and deliver real value in places like India, right? And so in no way am I contesting that there's value to having a programmable, centralized money. Now, the question is like, what would the mandate of a decentralized programmable money be like just kind of trying to set the hype of throwing the word blockchain on top of every service you could possibly imagine from the reality of what's to come. I think you're in an interesting situation where you might be evolving into this kind of partner that works closely with regulators and facilitates the creation of a great deal of value and facilitates trading. Now, recently we did see a recommendation that central banks potentially should ban stable coins, right, or heavily regulate them. So I do think that I mean it really is just like, is it converging on an open banking API that doesn't require blockchain technology anyways? Because if so, some people will be on board with that and others will kind of seek something new, right, or something different. And if it is going to be decentralized, let's just be honest about what the mandate of creating a decentralized financial infrastructure or money is. And let's be honest, but let's also be unconfused about the reality. I don't see it, challenging the U.S. dollar as a unit of account or medium of exchange anytime soon, right? I do see the potential for value creation and appreciation in a decentralized way through the creation of things like Bitcoin that are, about kind of storage and transference. And I do see it as an innovator's playground for new instruments that can be created. But you could say that a lot of the stuff that's being done in DeFi today is just kind of unregulated fi. It's like you're given a free pass because you're small, and so we can do a lot of clever, creative things. Maybe it'll be co-opted in a centralized system and be regulated, and that will be interesting and cool anyways. But I think it is, there is kind of a mandate for independent money. It does not have to challenge the existing system as a unit of account or widely used media of exchange. It can still do things like reduce exaggerated boom and bust cycles that central authorities care about too. They want that, right? They don't want weaponized interdependence. Nobody's fully happy with U.S.-China relations and things like that, right? Like, does China want their move to be like, I'm going to buy a bunch of U.S. bonds in a trade war? Like, how could that be a desirable situation? Why are they lending so much money to Africa, right? They want to increase kind of the presence of their cryptocurrency. And so much of the infrastructure that has been built in Africa has come from China because they want to create a trade partner, a real trade partner, so they're not so dependent on things like the U.S. for consumption, right? So they go there and lend lots of money, and that's why we have all this internet infrastructure out there now. And I could see that extending into kind of a central bank digital currency mandate as well. So if they want to become a serious player in a currency war, it would make sense for them to just loan a bunch of money and expect very little in return, right? And of course, if you're in a developing world and one party's saying, hey, we've got DAI, it's fully decentralized, right? Versus like, okay, well, you want a stable currency, we have one. By the way, we're going to lend you a bunch of money so you can build businesses and hospitals and consume a bunch of stuff. I think you're going to just take the best deal that you can, because if you're in the developing world and you don't have banking services, then you have a lot more problems, right? Than people out here who are like, look, ideologically, things like that make a lot more sense to me, right? But really, I'm just transacting in dollars on a credit card anyways. Like, I don't think that's just being honest or realistic about the true motivation there. And I think at the end of the day, it only has legs if it is decentralized. Otherwise, it's kind of neither here nor there. I'd rather just have TrueUSD or USDC or Tether or dollars in my bank account, or dollars in a money market account for that matter, right? So at the end of the day, I mean, when you kind of shake off all the nonsense, there's just a few things that stand out as useful. And I think, the lens of portfolio construction kind of lends great insight into that. Like, where do dollars sit? Not in my portfolio, because I have this thing called a risk-free return asset, right? Well, where does Bitcoin sit? Well, high risk, high reward, and perhaps things like what you're describing with MetaCoin sit in kind of a low risk, low reward thing. And I want to balance this portfolio with a bunch of assets, such that in aggregate it's less volatile, but I still have all the upside potential, right? So a Markowitz optimized portfolio, if you will. And yeah, I mean, apples fit right in there in the high risk, high reward diversifying segment. perhaps MetaCoin does, and things like TrueUSD. That's like when I move out of my portfolio, there's all sorts of other kind of utility cases for it that make perfect sense to me. My question, one of the questions I always had for centralized stablecoins or collateralized dollars was like when I thought about that early on, I was always like, well, isn't kind of that potentially a game of predetermined winners? Like, so Tether's out there today. It had that early advantage because it was connected to an exchange, right? And it was just on the shelf, right? I wanted to buy Bitcoin. I needed to upload dollars into a system. Bitfinex was there. They gave me Tether. I was like, fantastic. Now I can buy Bitcoin, right? That made perfect sense to me. But like, what if like something like, you know, Amazon creates a collateralized dollar, and now it's like, okay, I'm ordering a refrigerator, right? I'm uploading dollars to the system. They're giving me this Amazon coin. I'm perfectly happy because ultimately I want my, you know, refrigerator. You know, there's a huge advantage to that. And then obviously when you think about things like Libra, there are advantages to that. You and I are connected by this network trying to send you money. I upload dollars, fine, they give me this Libra coin, fantastic. I just want to send rough money, right? And the lowest level, it's like, okay, I'm a central bank digital currency, right? You go to the bank because you need to take out a loan or you need to deposit money. You withdraw money because you want stacks of cash and there's no more cash, right? Whatever they give me is what I'm going to take because it's there and it gets me to what I need done. So the one, you know, it's kind of in that sense a game of predetermined winners. If I look at like things like China, for example, maybe even more so there than here, right? Where you have this hugely vertically integrated stack where they actually do have a great deal of control over services like, you know, Alibaba and Alipay, right? And WeChat. Like at the end of the day, that is a game of a predetermined winner. There's no kind of collateralized stablecoin in China that's going to defeat a central bank digital currency in that regard. Maybe the US, yeah. So, I mean, in that way, I felt like it was a stepping stone to something else. And maybe you can talk to me about what that something else is, because I'd be interested in hearing your thoughts. I'm sure you've thought about it a lot.
Yeah. What do you think, Raphael?
Well, when you say predetermined winners, do you see like a U.S. central bank digital currency as a predetermined winner?
Oh, if they wanted it to be, yeah, right. So in the regulated, you know, right, collateralized stablecoin or central bank digital, if they wanted to, they could, right?
Yeah, if they wanted to make one, they could. It probably would take quite a while.
I don't think they need to, right? So again, this is kind of, I just was saying conceptually, right? So as an independent who isn't part of an exchange like you and like me, yeah, right? I felt, okay, if I'm going to launch a collateralized stablecoin, I'm always going to lose to the exchange like Coinbase launching it because it's already there. They already have the shelf. They already have the customers. They want to roll it. They have the advantage. And then I imagined, okay, if I was Amazon, right, would an independent want to compete with that, right? And like if you're Square, as an independent, you want to compete with that. And then if ultimately, as an independent, you want to compete with central banks or regulated private banks, right? So just in my opinion, it was always like there's always a stronger partner, and the strongest partner has an actual monopoly. So it's like I don't really want to get into that game because it actually just makes me into a bank, and like I don't have any problem with being a bank. I just have no business running a bank. You know, like that's just, you know, not something that I want to do or should be doing.
Well, I think that the winners are not, it's not so obvious because while you do have coins like, let's say, BUSD from Binance, HUSD from Huobi, you know, they have had some success, but one of the things that limits their success is that, you know, BUSD is so associated with the Binance that while it's quickly promoted on the Binance platform, a lot of other exchanges are naturally going to be hesitant to list.
Natural ban it because you don't want to support a competitor.
Exactly. And
gotcha. Some
people feel the same way about USDC, about HUSD, about these other products. And so I think that right now there are a handful of different coins that have different niches and different use cases. And it's not clear who's going to win which use cases. There likely will be many stable coins that can be pretty successful because, just for example, you know, it's very likely USD is always going to have a pretty strong market on Binance.
As long as Binance is pumping, yeah.
Right, as long as Binance is doing well, the USD is probably going to have a market there. But sure, how large will its market be outside of Binance? Unclear, you know. And and since its launch, it has definitely reduce the market share of coins like TrueUSD on Binance, but TrueUSD is still doing very strong and quite dominant in other use cases and other niches. So I don't think it's quite clear who's going to win. And there is no question it's a big advantage to have a large exchange or an existing channel, but I don't think that it guarantees you're going to win beyond that.
Right. Fair enough. Yeah. I think in China, though, the central bank digital currency does win. That one. Those guys.
That one's pretty solid. Yeah, I agree.
Yeah. Okay.
I like that. And just to kind of wrap this conversation and kind of move into a separate topic, just before we do that, Stefan, do you have any thoughts on some of the things that we just spoke about?
Yeah, I mean, you also showed us a graphic a couple of days ago about how USDC, DAI, and Tether are used in different niches. And yes, I think each stablecoin will have its own kind of locality where it will be appreciated by a certain group of people, and they will interact. People will interact between different localities by going through a chain of stablecoins.
Yeah, it does seem like that's happening to a certain extent. TrueUSD is really popular in South Korea, really popular in a handful of businesses that pay their employees using TrueUSD. So we see a lot of different use cases, and it's not always clear why a particular market or a particular group of businesses and individuals will choose one stablecoin or another. But there are some network effects that once you get established there, then it is harder for another stablecoin to come to place.
That makes sense. Like the dollar is the ultimate stablecoin with massive network effects, right?
Yeah,
and a military, and the whole kit and caboodle. Cool.
I'm just going to go ahead and share my screen and show the audience the image we're referring to, because I think, Stefan, that is a very fascinating kind of image, and kind of does a really good job of describing the use cases of some of these stablecoins here. So I'm just going to go ahead and do that so the audience can see right now. Just bear with me 1 second, and then we'll talk through it, and then we'll kind of jump into it. So hopefully the audience can see this. Can you guys see this on your screens? Yeah. Okay. Perfect. Yeah. So it is a fantastic. Let me just enlarge this once more. 1 second. Yeah, it is a fantastic kind of graphic, and it's from Flipside Crypto, I believe. And what it does is it shows the different types of stablecoins that exist and their uses within different applications in the DeFi ecosystem. So if you can see up here, the key is USDCT, which is in green, the USDC, which is in blue, and then the DAI, which is in like yellowy kind of color. So if you can see down here, this is all of the activity around DAI, and as you can see, you've got multiple different protocols and projects that are being used with this stablecoin. You have pulled together here CurveFi, Aave, 1inch, DeFi Zap, 0x, Uniswap, Kyber, Gitcoin, Oasis, got Diversify in the corner over here, which is very interesting. And then as we come up here, obviously, I think that goes without saying, USDC is quite heavily used in Coinbase. But what's interesting here is that it's kind of a bridge. So as you can see on this side, it's a lot of blue, which represents USDC, but then there's a lot of kind of a mixture between a blue and yellow, which means that Coinbase is kind of acting as the gateway between USDC and DAI, which I find to be very interesting. And then if we go all the way here, we can see that the USDT Tether is being used in multiple different projects, and so is USDC over here. Huobi, Fcoin, OKX, Bkey, Binance, of course, Bitfinex, Bittrex, KuCoin, BitMax. Yeah, and I thought this was super interesting, and thank you so much for bringing this up, Stefan. Maybe we could chat a bit about this and some thoughts that you guys have on this.
It's interesting. Yeah. Also, in that chart, you can see that while Coinbase is sort of a bridge between DAI and USDC, Binance is also bridging between USDC and Tether, and has pretty low, pretty limited interaction with DAI, but large interaction with USDC and Tether. that's you're kind of seeing how people move through multiple stable coins to get around between DeFi and exchanges and the apps they like.
Yeah, I mean, it does seem like Coinbase is a natural fiat on-ramp, right? So it's a starting point. It happens to be a fiat on-ramp that allows you to exchange for DAI.
And
right?
USDC, but not Tether.
And USDC, right? But not Tether. And so it makes perfect sense for it to sit right there. But the two splits are also very apparent in that everything on the left was basically a centralized exchange, right? We saw with OKX and Binance, a bunch of centralized exchanges on the left. And on the right, we saw, a lot of kind of decentralized kind of applications, which could have easily used USDC as well, but you saw a lot more DAI usage over there, right? Why? I think because ideologically, it sits better with people who are building decentralized finance to have the underpinning of that be itself a decentralized stablecoin. Now, I think we started to build all this kind of programmable infrastructure on top of DAI, and we got a little bit ahead of ourselves. So as builders, it's very fun and desirable to kind of write code, right, and to do things, right? But the fundamental building blocks that underpin our ability to continue to engage in the joy of building together, that ecosystem, that open source vibe, that the underpinning of that is finally being called to question. Now, I think it should have been examined intellectually before we got so ahead of ourselves. But here we are, right? And now we got to plug this hole of how do we make this decentralized ecosystem happy with engaging in the open source work that they're doing ideologically? We need to kind of fix the primitive problem, right? We need to fix the DAI primitive problem. And most importantly, what is DAI collateralized by? Cryptocurrencies, right?
Yeah.
ETH, right? Basic attention token. We need to fix the hypercorrelation problem, right? For a number of reasons, right? Not just to make decentralized programmers feel good about what they spend their time on and slave away at, but just for pure diversification, right? To de-risk the interconnected nature of the current global economy, we now have things like Bitcoin that are slightly less connected. And if we can create more assets that are neither connected directly with Bitcoin nor with traditional assets, then we can continue to de-risk that. That's just kind of the bigger picture. And in this micro picture, yes, for sure, we are facing a hyper-correlation problem. No question about it. That's why we have to get so clever about these collateralization protocols, and we need all these kind of intermediary volatility instruments and derivatives to just patch together some semblance of a primitive that we feel good about spending our time on as open source developers on the right side of that chart. Now, on the left side of the chart, people are just trying to make money. They'll use whatever it takes, right? Whatever's on the shelf, whatever has the cheapest fees, whatever has the deepest liquidity, whatever lets them take the largest margin bet or hedge, right? And a lot of people are moving towards just leverage Bitcoin trading because they realize that all of these, currencies are so tightly correlated that it's almost like just having more beta on Bitcoin. So why bother? Why bother even buying them if I can just kind of add a little bit of leverage here and there on my Bitcoin position or my ETH position, right? And that's not healthy either, right? Because we want more diversification as well. So you can see this fundamental problem, what I think is actually the biggest problem in the space of hypercorrelation, percolating into every avenue of behavior across the ecosystem, right? So we see it resulting in the collapse of DAI, right? And all this kind of frustration for the DeFi ecosystem, right? We see it, affecting kind of portfolio managers who okay, in theory, there should be a reasonable allocation for Bitcoin in your portfolio, but its volatility is so high, right, that your risk tolerance has to be really high in order to justify it. So instead, what they do is they just sprinkle a little bit of money in. I just want access to this asset because it's been the best performing asset of the last 10 years and of the last year, right? I can't put enough money into it to consider it really part of my portfolio strategy because it's still too volatile. But we could see a lot more institutional money enter the space if they could buy a basket of assets that in aggregate were slightly less volatile, but still high reward, right? So there's a position for high risk, high reward. It's just a Sharpe ratio. There's a numerator, expected return, and denominator, right? Basically correlation, right? So you can look at the covariance of all the assets in your portfolio, right? And you want that covariance to go down, the denominator to go down, and you want your expected return to go up. And Bitcoin's great because it has hyper return potential, so it increases the R, right? But its volatility is so high that it's not doing a lot of work for a lot of these portfolios. So if in aggregate they could buy a crypto index that was less volatile but still had that kind of return profile, then I could see portfolio managers allocating a lot more money into the space at large. So solving the hypercorrelation problem would bring more money into the space. It would be harder to justify pulling money out of the space because you're a little bit more diversified. And it could create for a better foundation for a potential alternative finance ecosystem. And it can relieve us of this interconnected, global macro economy, right? Where the US is the world's consumer, China is the world's kind of producer, right? Everybody wants to denominate in dollars, and constant dollar demand makes it easy for us to, basically forces us, it's not even makes it easy, it forces us to lend aggressively, right? So when people keep on hoarding your dollars outside of the country, you don't want that to affect output of prices domestically, right? So what do? You lend, you create more liquidity for the people of the United States. And what do those people do? They don't consume 1,000-fold. They invest in short run speculative assets, right? And so this asset bubble gets created, and we see exaggerated boom and bust cycles and growing deficits. And that's what they call Robert Triffin's story. So this has been known since the 70s. And that's kind of what we see today, the conflict of interest in being kind of global reserve currency and domestic currency. And the way to challenge it, I think, is not to even challenge it directly, but just simply to give people some sort of asset they can invest in that's disconnected from the existing ecosystem, and large enough and liquid enough and diversified enough to actually make a difference that kind of becomes a win-win for all parties.
Sorry, go ahead, Rafa.
Yeah, so far, at least what we've seen in the last couple of months, coronavirus has caused a major crash in the U.S. economy and the world economy. And so far, Bitcoin hasn't fared particularly well. But I do think in the long term, it is somewhat promising for Bitcoin and for crypto in general, because it is really highlighting for the entire world that
how connected we all are, right?
Both how connected we are, but also just that the existential threats that face our species and even more so our financial system are very real. And while coronavirus, is not going to wipe out our species, and it's not going to wipe out the dollar, it's not going to wipe out the entire U.S. financial system, but it definitely emphasizes for people, there are big waves that can hit us, and thankfully this one has not completely flattened us, but the next one could. And so that does bode well for people starting to look around more and think, okay, what could we potentially build? What could we potentially use that might be a bit more resilient?
Yeah, and so I think, one thing I want to clarify, not for you, but just for anyone who's listening, because a lot of people get this kind of confused, and it's the notion of being a safe haven versus being uncorrelated, or being an uncorrelated risk asset. So a safe haven is something that you retreat into when you're afraid of risk, essentially, right? And in a panic sell, I don't want any more risk at all. And the least risky thing I can retreat into is dollars, right? Which is why you saw everybody move into dollars, or collateralized dollars, the next best thing, right? So it's like, you want to take all risk off the table, and that's great. That's a panic sell, right? But in terms of just assets in general, there's also the notion of being an uncorrelated risk asset, or being uncorrelated over longer time horizons. So we saw people retreat out of gold and other things that people call safe havens. Like, at the end of the day, in a panic sell, the only safe haven is the dollar. And then you're going to look at your portfolio and you're going to think about how to readjust, right? How to rebalance, and how to actually make bets. And so one of the things I'm concerned about is what if it takes us a lot longer to kind of reboot the economy than we expected? Right. So what if the doomsayers and kind of the perma bears out there are just saying, hey, we could be stagnant for a while. What if it ends up like 90s Japan, where it's not that we're afraid of losing all our dollars, we're just not seeing a lot of growth, we're not seeing a lot of consumption, we're not seeing a lot of output. I think that's actually when an uncorrelated risk asset like Bitcoin, or one of the opportunities for an uncorrelated risk asset like Bitcoin to really shine, because its price can appreciate without global consensus on what something like a a healthy PE ratio is, right? And so that's where you see, I use this example because it kind of hits home and they're like, oh, okay, that makes sense, right? So after 2008, we saw this huge collapse and there was this huge desire for volatility actually, because it took a lot longer for us to get back to the previous all-time highs than anybody, wanted, right? And so there was this frustration, this desire for justifiable risk. And by justifiable, I mean like high risk, high reward, or higher risk, high reward. There are always going to be opportunities where you can take a lot of risk and get no reward. Those are just bad investments. But like the problem was the global consensus around healthy multiples was only evolving at this rate, but you wanted your portfolio to grow back faster than that. And so there was this kind of search for volatility or search for risk, if you will, and it kicked off another asset bubble. But like, yeah, I mean, what happened here? Like, look, COVID hit us, right? We're probably going to survive as a species. The economics, system takes a little bit of damage in the near term, but yet we're also just, the U.S. is stimulating the economy in the order of magnitude of trillions, right? So what happens when you create all that liquidity? I'll tell you this: it's not consumption. Right? If you're getting a $1,200 stimulus, yeah, I think so. I think like if I'm rich and I'm borrowing a bunch of money, it's not reasonable for me to eat 1,000 times more food. I'm just going to speculate it. And if I'm poor, I'm gonna save as much money as I can, right? Try to survive, right? So it like being able to kind of speculate on something different or store value in something different is actually useful in that situation. But I think that like a healthy pressure against that very particular dynamic where we can't actually get out of the cycle of continuing to do that, it's this intractable problem where we have to continue to like jumpstart the economy. We have to lend, that people have to borrow. They're going to consume some so that we can actually have a functioning economy, but they're going to put the rest of it in speculative assets, and then the bubble will grow again and collapse again. And it could happen in bigger and bigger magnitude, and has happened in bigger and bigger magnitude. It's just like this intractable problem. It's kind of abstract, the way like global warming is abstract, doesn't affect me day to day, but it's something that a lot of economists have been concerned about for decades, and there's just no answer for it. Every kind of presidency goes out there and promises they're going to eliminate the deficit or balance the budget, right? And we just all know that's not going to really happen. It doesn't. It's okay that it doesn't happen, but it's kind of concerning that like it can't happen. It's not like that. I'm like, oh, it didn't happen. Like we're all screwed, right? Like no, I'm just kind of concerned. Like, okay, but what happens if it's actually intractable and it's just growing deficits forever? At some point, there's faith loss that people will repay debt. Like if the U.S. government can't repay debt, that would be a huge disaster. And I just think diversification is good, right? So I don't like these kind of intractable repeating cycles. I think that is, the Triffin dilemma. It's one of those kind of paradoxes in economics. I think things like Bitcoin can help escape that, right? And it's not by challenging the dollar as a widely used media of exchange. So I just really don't like it when people predicate the success of cryptocurrencies or Bitcoin on being able to use it for coffee, because it's the last thing I want to do with my Bitcoin is exchange it for coffee. It makes no sense.
A quick tangent to this, actually. A quick tangent. I think the next DeFi wave will be focused around hedging. So once we have primitives like AMPLs, Reflex Bonds, or even systems that have high volume in terms of derivatives traded, people will try to build other DAI-like systems that are better than what we have now. But then we might find out that at some point that even the current derivatives or hedging strategies that we have are not enough. So we'll go back to hedging. So I think in the long term, we'll just go between hedging and creating money, the ideal, stable, decentralized money that Evan was talking about. And I think this will continue to play out in DeFi.
Yeah, that makes sense. I mean, look, we already have a lot of hedging. So there's two ways of risk reduction. One's diversification and one's hedging. Right? We have a great deal of hedging in crypto going on right now, right? So we see people taking simultaneous short and long positions, sophisticated traders doing this like 24 hours a day, right? What we don't have right now is diversification of any sort, which makes kind of a risk-reduced investment model inaccessible to people who can't afford to spend every hour of their day hedging or can't get their money into funds, into the hands of traders that are willing to do that for you. And so, like you said, these instruments that kind of simplify that for people and do that for people are helpful. I think they can be taken much further in terms of risk reduction by things like diversification as an infrastructure for creating more automated hedging than otherwise, because like automating hedging will always kind of lose to a real trader, because like once you know the rules of the system, you can kind of abuse it. So in terms of making it rules-based risk reduction, I think we need more diversification now. And it's what we don't have, right? So if you're going to ask me which is more important, diversification or hedging, I'd say like pick one, I don't care. But right now we have an over-representation of hedging and no diversification. And the problem with hedging is it's not very accessible to the end user unless they have their money in a hedge fund or they spend every hour of their day doing it. And the other problem with it is it's much harder to make use of in terms of as like a synthetic or as a derivative or as like some sort of instrument that can be packaged and delivered to consumers. So yeah, I kind of agree that DeFi will naturally incorporate more of that. We see that with like, what's it called? Set protocol, token sets, right? I can follow this portfolio, a basket of assets. And because these portfolios are so hyper correlated, one of the things they hold in those baskets is a stablecoin, right? And so rather than automating the trading strategy of hedging between collateralized dollars and something like ETH, what you do is you follow a trader who moves in and out of ETH, right? So he rebalances like often between like ETH and dollars, and basically they're saying, is it going up? Do I think it's going up? If so, I'm going to expose more ETH. Is it going down? If so, I'm going to expose more dollars. It's just like the simplest thing you could possibly do. That's just like the beginning of it. And so the more we can empower systems like that to provide some sort of risk-adjusted model for end consumers, yeah, the more value we can deliver to your average crypto investor. And I think that's cool too.
Well, Evan, a trivial way that one can get it can have sort of an uncorrelated, diversified return in crypto is just like, buy ETH for Bitcoin or buy that for ETH and Bitcoin.
Say that again. Sorry, you muted out again. So this is a way to diversify.
Buy ETH for Bitcoin, or buy basic attention token, short ETH. Those are all ways, if you want to be able to trade something that is uncorrelated with Bitcoin. You can pretty easily construct that.
Yeah. So actually, financial engineers have been creating these synthetic portfolios for a very long time, right? So simultaneous short and long positions on a single asset, or combinations of short and long positions on a basket of assets. I think one of the cool things about Bitcoin is like we finally now have been able to synthesize something atomic. So we've never seen that kind of randomness before. So like, I could, if you're a finance engineer, you could take a short and long position on Apple, but you could never create Apple, right? The atomic unit, right? It's almost like they're molecules, which are these synthetics, arrangements of atomic units, and then they're like atoms, right? So you're not the one, but for the first time, they created this synthetic commodity money, Bitcoin, right? And we've been able as engineers to move into that atomic layer. That's what really excites me. More of these atoms, right? Because that was really the miracle, I think, of Bitcoin. That you're able to now finally synthesize the underlying asset, not just the arrangement of assets. We've always been able to do that, and like I said, sophisticated traders will always do this. You can risk reduce by hedging. Now we want to enable risk reduction by diversification, right, through uncorrelated assets. But that's kind of the crux of it. I think that we've always had people for decades trying to create synthetic portfolios. Why? Because they want to reduce correlation with other portfolios. But now we've been able to finally synthesize the underlying asset. And by the way, its randomness is something we've never seen before. We've never been able to just create the kind of randomness that Bitcoin has. So new flavors of randomness, I think, are actually very powerful, and it's super interesting. And I see that as one of the great miracles of Bitcoin. The other miracle of it, and this is following something that they call Mises regression theorem. So Mises regression theorem seems to say that like something that has value is always previously connected to something else that had value, ultimately being connected to time. So my time is valuable. I commit my time to a labor effort. I produce some wheat. Now that has value. And now let's collateralize wheat and call it, an instrument, right? Or like gold, right? I take a bunch of gold, I mine it, has value, let's collateralize the gold, right? And then finally, what moved beyond that was, again, in Bretton Woods, when we left the gold redeemability, we had pure fiat that was collateralized by nothing, right? It was just paper. Of course, it was dependent on having sovereign authority, but like we moved beyond that. They never really expected something like Bitcoin to be able to bootstrap nominal exchange value or value in these secondary exchanges without having ever been connected to some other asset that already had value. Because it didn't have any value to begin with. It had nothing to do with like, the time you spent. And of course there's mining, but I would argue that mining is a lagging indicator of demand. So if demand goes down, then the cost and difficulty of mining goes down as well, right? And so it's not quite the same as something like gold, where the cost of labor and the marginal cost of producing more gold can be kind of considered an equilibrium in the long run. It's different, and so it broke Mises' regression theorem in that it was the first asset that was able to bootstrap nominal exchange value, like exchangeable value on a secondary exchange, without ever being connected to something that already had value before. And now in Bitcoin's kind of warpath, it's bootstrapped the ecosystem of a bunch of exchanges, which allows token developers like me and you and anyone else to create a token that can quickly have nominal exchange value without previously being connected to an existing asset. So that might be a phenomenon that we can't really recreate, but the good news is Bitcoin did it, and now it's created this ecosystem. So we can continue to create these atomic synthetic commodities as opposed to just molecule level derivatives, synthetic derivatives, right? And so super exciting stuff. I don't know if I got a little off tangent with that one, but I was excited. Yeah.
That was pretty cool. I liked how you kind of outlined that. I realized that we're coming into the last half hour of this conversation, so I thought we could maybe talk a bit about a lot of folks in the chat have been kind of talking about this, and I thought I'd bring this up. Stablecoins have, and Evan spoke about this earlier on in the conversation. I'll very quickly open up my screen again to show you this conversation. Let me just do that now. Just bear with me 1 second. I'm going to present my window. I'm going to go back again. It's the G20 watchdog. Essentially issued a recommendation for the global regulation of stablecoins. And so...
you had to bring that one up.
Sorry, what was that? I missed that?
You had to bring that one up.
Yeah, I know.
No, it's pretty cool. Or I mean, it's big news.
It is an interesting breakdown. So first and foremost, for those folks who aren't familiar, it's a piece here that's been outlined by the block and many other outlets. First, let's talk about what happened. Then let's talk about the importance of this and I guess what the effect this might have on the ecosystem. Maybe we could start off with Raphael, because you might have some thoughts on this, and then we go around to Evan and then Stefan.
Sure. Yeah. So I guess the news is it's a recommendation that has been published by the Financial Stability Board that they're making certain recommendations to central banks around regulating global stablecoins. I think it's just part of a broader discussion as regulators and central banks start to understand stablecoins and figure out what they want to do about them. But I think that there's also a lot of pressure on regulators and central banks to not stifle innovation and technologies that could be very valuable for the economy and for consumers.
Yeah, I mean, so from my perspective, this is something that we've been expecting for a long time. It's like Brandon and I always kind of say this, like if it can be regulated, it works until it doesn't. And so I think this is, something that Libra really jump-started, right? So when you think about Facebook, a network that has like billions of people, like bigger than every country, deciding that, they're going to launch their own digital currency, then all the people who are really in control of currencies get a little bit scared because they're like, wait, what? We can't let that happen. I need to do my job, right? I have this mandate to maximize employment and make sure that, interest rates are moderate in the long run and that prices don't kind of skyrocket. I'm not going to be dealing with, some teenager increasing, the supply of money willy-nilly. We're going to regulate these people because at some point that could actually prevent me from being able to protect my nation, right? And so it's natural, I think, for them to have a mandate to care, because now, in theory, it could matter. It could affect the way they do monetary policy, and they are going to try to regulate it eventually. If not now, if it succeeds, they're going to regulate it. And yeah, it could be, well, I mean, again, one of those things that makes you feel bad as an open source developer trying to build an alternative finance ecosystem, that like the underpinning of it could be regulated or taken away, right? That never feels good. When something you care about and you spend a lot of time on and you believe in can be taken away by something that you don't control at all, it always feels bad. But I think it highlights kind of, what the progression that I was talking about earlier, which is like there's always a predetermined winner in some sense, right? So, at first it was like I'm independent versus there's an exchange. And like I appreciate the argument that exchanges want to compete with one another and won't support one another, so there's a role for an independent. But then eventually the e-commerce platforms and the communication platforms and the banks themselves have advantages. And the ultimate advantage is actually a central monopoly, and that's kind of the fundamental issue with the sovereign monopoly, I think, is that, I mean, I guess this is just me parroting the words of Friedrich Hayek, but like unlike law and language, money has not been allowed to evolve by forces of competition, and as a result, we haven't explored other systems and arrangements that might be more efficient. And so it's time to kind of explore. That was his kind of, the song that he sang in the latter years of his life. And much of the ideology of crypto, particularly with Bitcoin, has kind of evolved from there. Again, I think today, the best and healthiest way to kind of challenge the existing dollar is actually not to challenge it. It's actually just to challenge the problem of having a hyper-connected global macro economy and provide some sort of diversity that benefits all parties. You can see central governments, appreciating that without it, affecting their ability to kind of regulate the supply and issuance of money. I think that the moment that they'll get really scared, or the moment I would get scared if I'm a central bank, is when people start to denominate in a currency that I can't control, and if it's big, because that's when it starts to pick up a little bit of price and wage stickiness. But yeah, I mean, I don't know what to make of what it means in the near term. I think all of those major players, and Raf, maybe you can chime in on this, will comply with the regulators, and won't ultimately affect their ability to regulate the supply of money. You have to be pretty big, to actually affect those jobs. And could you have like $100 billion in a bank account? Yeah, people do have, like Warren Buffett, right? Could you have trillions of dollars in a bank account? Yeah, I think so. And if it's regulated, would that, be kind of enough to make sure that doesn't affect the central planner's ability to do their job? Yeah. So it has to get really big, or it has to be just kind of, I don't know, dangerously powerful. So, for example, I think like the idea of a purely algorithmic stable coin that can't be regulated, that could challenge the dollar and grow and become insanely big, is still ways out. It's just hard enough and maybe impossible enough that like I don't see that happening anytime soon. But yeah, I think with things like Bitcoin, and so that's kind of what I think about Ample is like, again, this is a reminder that we shouldn't be calling Ample a stablecoin. We try to go way out of our way to kind of say that, but it's really the closest thing to Bitcoin that we could imagine that's like significantly different. The closest thing to Bitcoin that we could possibly imagine that moves differently or can be less correlated, and it's just not even stable. So it doesn't affect me so much, but I would imagine, Raf, that you would just kind of allow yourself to be regulated because that's part of the path that you took to begin with, and it seems like there are legs there. It's better, what's the alternative? Some unregulated bank?
Yeah, I mean, we're compliant with regulations today. I think if the regulations changed, we would comply with any regulations.
Yep.
We're not aiming to take our coin right now down the Tether path, but I think what this document and what this news is saying, I think it really is just regulators starting to have the conversation about how they want to regulate stablecoins. It's not clear what they're actually going to do. And if you read the actual recommendations that it's making, in some ways they're pretty bland. Things like authorities should apply appropriate regulatory requirements to global stablecoins, on a functional basis and proportionate to their risks. They're saying you have to somewhat assess on a case-by-case basis. Depends on the type of stablecoin, depends on the situation. So I think it's still just TBD and see what actually comes down the pipe in terms of regulations of stablecoins.
Yeah.
But I think it's more of there's a question for us. I think we've got a regulatory team, we've got a compliance team. We already do a lot of work on these lines. So I think it's fairly just in the same business for us.
More of the same.
It's more of the same. I think there is a question for things like DAI, Ampleforth, MetaCoin, and so on, of what will happen when there is a clear regulatory regime, and we could end up in a situation where regulators are saying, look, you have to. They might have very clear regulations. You have to do A, B, and C, or you can't launch a coin. But then there's a question of, for some of these coins that are purely algorithmic and may not necessarily need a company that's actually managing them on a day-to-day basis.
Yeah.
Going to comply, or are they just going to do what they want to do anyway?
Yeah. If that's the whole Bitcoin way, right? It's like there's no one. Even if you find the creator of Bitcoin, you send him into jail.
Right.
Bitcoin is still there, right? Because it's an unregulated, decentralized asset.
That's the thing, actually. So that article has an interesting loophole. They still define stablecoins as being linked or pegged to an asset or basket of assets. Thing is that we crypto developers are pretty smart when we can create other assets that are kind of like stablecoins but are not stablecoins, and we can just start all over. They tried to ban Bitcoin in the past couple of years. They didn't manage to. Now they're trying to ban stablecoins. They won't manage to do it.
Yeah, I think they'll regulate all the biggest ones, and I think there will be a great challenge to see whether a decentralized stablecoin can actually be created. But yeah, I think I agree with what both of you guys said.
Yeah, it is an interesting time, and I guess these are the roads aren't really clear. This was just kind of a suggestion, and so I think it's important to bear that in mind. In that who knows where this could potentially go. But these are all very valuable. Do you want to touch on that very quickly, Raphael?
Well, it's still very unclear. I think this is just the Libra has, as Evan mentioned, Libra has sparked all the regulators and central banks are now thinking about it very actively, but it's still not clear what's going to happen.
Yeah, and there's a bigger game too than this, because this is G20, right? So, and you see, like, for example, if China has a mandate to create a collateralized a stable coin, if you will, in the form of a central bank digital currency, are they going to be regulated? I don't know. I think that we might already be in the beginning of kind of this Cold War with China, so to speak, right? It's a trade war, a technology war, a currency war. Like, by a lot of measures, that's already happening, and it's not clear. I think it's not clear exactly how it's all going to play out. But I do think that one thought is interesting. Imagine if something like Bitcoin could eventually evolve into a stable coin, right? Would they be able to ban that and regulate that? I don't think so. But it can't. It's not likely to.
Right, it's got fixed supply. But if it could, I think it would be very difficult to ban or regulate.
Yeah, and that would be I think make it a little bit more difficult for these guys to do their jobs. But then there would be this natural competitor that's wreaking havoc not only on G20 nations and the Western economies, but the Eastern economies whom we're at war with too, in the current Cold War, currency war, trade war, technology war, not hot war, right?
Yeah.
And then what happens if you've got this agent of chaos out there, right, who's putting pressure on both of those parties that can't be regulated? Does the system itself then have to adapt and become more efficient, right? Like the IMF, I remember reading in a magazine, was saying like, hey, look, if this does happen and we do enter a world of like, these conducting open operations on commodity monies, then we better get our game together and become more efficient central banks. And that was kind of the tone of her statement. But that's an interesting scenario to contemplate, and it does underscore whether you can be regulated or not, and whether you're successful or not. So if you're something like DAI, which I think is centralized enough and successful enough that you can actually just be regulated, so you're not truly permissionless, then you kind of fall victim to that. If you're something like TrueUSD and you were regulated from the beginning, I think it's more the same. And if you're something like Chinese central bank digital currency, I don't know what they do about that. But I'm interested in seeing.
Yeah, it is going to be interesting to see how that plays out. So I guess folks in the audience are asking some questions, so maybe we can kind of run through a couple of those before we kind of wrap up, and then maybe we'll give shout outs to each and every person on this call in terms of the projects and where they can find out more. I know people are like ranting and raving, wanting to know more about MetaCoin, because obviously this is very new. So definitely going to give a shout out to Stefan towards the end. But very quickly on the question. So DeFi-licious says, would a prominent stablecoin provider, USDC, DAI, TUSD, collaborate with local players? And then he follows up with, what's necessary for the big players to enter these developing markets? That's the question. I don't know. If you maybe want to elaborate on that, DeFi-licious, while these folks attempt to answer it?
Yeah, I mean, we're certainly happy to collaborate with local players, and we already do to a large extent. There are a lot of smaller local exchanges, dApps, apps that OTC desks that use TrueUSD, that use True British Pound. We've got some really exciting partnerships that are coming up in the UK around True British Pound. And so for any of our stablecoin products, please reach out to us if there are partnerships or ways that we could products can be helpful to you.
Awesome. And just he kind of follows up and says, what's your take, guys, on stablecoins in developing countries and how they'll play a role? If anyone wants to kind of take hold of that one.
Right now, we can actually see exchanges like Binance going into Africa. So they're starting to create stablecoins, local stablecoins, on top of Binance DEX, and they're trying to bring DeFi, or at least normal finance, into Africa. Right now, there's not really a lot of activity there, but I guess that in the next 10 years, most DeFi activity and even CeFi activity will take place in Southeast Asia and Africa.
I think a little bit differently. So I don't know that the value proposition is as distinguishable if you're in the developing world and you don't have, let's say, banking services. I think you just need banking services. You care a little bit less about whether they're decentralized or not, and it's about who can penetrate and offer you the strongest value proposition. Like I said, if central governments like China, for example, have a mandate to advance the dominance of their currency, they also have the power to lend a bunch of money to Africa and a history of doing so, billions at a time, with no expectation of repayment, because they want to create a trade partner so that they're less dependent on U.S. consumption. And so I think it'll be very difficult for a decentralized alternative to compete directly with something like that, just because of all the kludginess of the user interaction and the lack of emphasis on ideology out there. So I think it might be difficult. I don't know where we are 10 years from now, but I don't see the value proposition being as strong as it's had been sold to people, including Libra, right? Like they were waving that flag of like, we're going to bank the unbanked.
Well, we do see a decent amount of use in terms of essentially banking the unbanked. We've got businesses that will come to us, that folks that we've never met before, that will say, hey, I'm using TrueUSD on a weekly, monthly basis to pay my employees, who many of whom don't have US bank accounts, or I just don't want to have to send a lot of international wires. So we're already seeing that use case. Now, today it's probably a lot smaller than just like the crypto trading use case, but it's sticky. and it's a very real use case.
That's true. I mean, I just keep thinking about if you control WeChat and you have a mandate, right, in Latin America, for example, to get as much adoption for your currency as possible, and you have the ability to kind of lend a lot of money, it's a weird partner or competitor to go up against in the long run. But I do think it could fill a niche, in between here and there, right? It can draw attention to opportunity. It can provide value. But yeah, I mean, it's like you said, at the end of the day, it's like, look, I just need I don't want to have to create a US bank account, right? And, they don't have one. I want to be able to send it, right? It's all those matters of convenience and necessity, not matters of ideology. And so, you'd have to win, right, on usability and basic value proposition, not on, other things, right? So not on price appreciation, obviously, and not on ideology. So I don't know that DeFi can compete necessarily with like a central bank digital currency that has a vertical integration with a massive communications platform and the ability to lend and mandate to engage in a currency war, if you will, on a global scale.
Yeah, I'd say that's very unclear what's going to happen if we have the Chinese government or Facebook massively promoting their own currency and using products like WeChat, WhatsApp, Messenger, and so on. I think it's very uncertain.
Yeah.
But there are also a lot of local competitors that may want, think the local messaging apps that may want to compete against a Facebook or a WeChat, and want to integrate something themselves that can provide a lot of the same functionality. So
yeah, and if they have the ability to regulate and prevent people like WeChat from entering or Facebook from entering, then
might want to.
Yeah, they may want to.
This is very true, and it'll be interesting to see how this plays out. So just to kind of wrap up, and I know we're going to run over here, but I think that should be okay. I guess we'll jump into shoutouts. So I think first and foremost, the one that kind of everyone's been wanting to know more about is MetaCoin. So and Reflex Bonds and all the amazing stuff that you're working on, Stefan. So maybe just give us a quick shout out and say where folks can learn more about what you're working on.
Well, maybe. Can you share some links after we finish?
Yes, of course. Yeah, we'll drop all the links in the description, and we'll follow up with everything.
All right. You can always find me in the Reflexer Discord group. So Reflexer will be kind of a different project compared to MetaCoin. Reflexer will focus on Reflex Bonds, but we will also make the actual code that will be used by MetaCoin to deploy MetaCoin. So the two projects will be kind of linked, but they won't be the same. We will advertise them in different ways. Reflex Bonds are more like infrastructure. MetaCoin is actually that idealistic coin that we all want, like DAI, but more decentralized than DAI. And you can actually, so you can go to Reflexer to find me. You can go to Twitter, to my account. You can maybe read the first article I posted about Reflex Bonds to get the general idea about what we're building. I will post other technical pieces in the next couple of weeks. I'll post about our infrastructure. I'll post about how we handle oracles and so on. And you'll soon see even a white paper. Maybe I'm targeting right now mid-May for the white paper.
Can we make Reflex Bonds on tokenized currencies like Super Pound, True Hong Kong Dollar, and so on?
Actually,
that could be cool.
Can we make a Reflex sample?
We
can, right? I saw that. Yep.
I think Reflex Bonds are useful when you actually have something that's more volatile, or that can explode at some point, like bad mortgages. I don't know, some synthetic that's kind of some BS controlled by central bankers that at some point might blow up, and you want to hedge against that. So Reflex Bonds are useful when you want to have some infrastructure that helps you when things blow up and you need more time to kind of think, how do I diversify? MetaCoin is actually that coin that you want to use, and maybe you can take our code and use Trust to collateralize Meta and then use that for DeFi. So different target groups, different missions.
Well, I mean, if you're collateralizing Trust, then you're centralized again, but it would be a spin-off, right?
Yeah,
It would,
yeah. I mean,
it would be like Maker collateralizing USDC. But I would urge you to think very, very deeply about the potential liquidity issues. Like I said, with repo markets, with Argentinian bonds, with Venezuelan bonds, if your supply is not being dictated by demand for the actual coin, right, or like DAI, and it's instead being pushed around by the demand patterns of the underlying collateral assets, and they're in a feedback loop with one another, you could enter a very, very impossible scenario. And so I would argue that's the scenario that Maker entered into out the gate. And I would encourage you to avoid that. And I think maybe you could, like, I'm happy to look at anything. But yeah, buying time makes sense. Just be aware that if you're dependent on an additional marketplace to regulate your supply by incentives, that might not actually work out the way it's supposed to, just as it does with, like, again, repo markets, which is the simplest example I think of a collateralized debt position and an incentive mechanism for regulating it. So a liquidity crisis, as we saw with DAI, is something that, like, we should take 2, 3, 4, 5 looks at before making any big promises. I know everybody's really hungry for a replacement for DAI because, like I said, it feels bad to build this decentralized ecosystem without some sort of placeholder for it. But I also think that it's possible that we're getting ahead of ourselves and just look at all the literature that already exists.
Well, if we talk strictly about Maker, the problem with Maker is that they don't really have enough tools in their toolbox to actually try and influence the market price. They are always trying to force the market price back to the same target, which is the problem. We need to have a more reflexive or a more kind of malleable system that can adapt to the current market conditions, not just bring the market price to the same stone that we have somewhere around there.
Right. I mean, so we kind of took the same approach, and that's how we ended up with Ample. When we took away all of the BS, right? What remained was something like Ample, and it's ends up being a totally different thing. But if you add the collateral and you allow it to float, maybe you can buy. I think just articulate the value proposition that it is, as opposed to what people want to hear, because I think that'll help. So think deeply about the promise that's being made. Like Bitcoin was very clear. It's a very simple promise of absolute scarcity in a specific emission curve. It wasn't promising stability, though it did call itself a cash. And I think with Maker, you're right. They handicapped themselves in the sense that the promises that they made it harder for themselves to give the toolkit that could adapt to a changing circumstance. And you want to just be careful with the promise that you make. Like if it's like, hey, this is like the perfect solution to Maker, as long as it's depending on a secondary marketplace of incentives, no matter how strong those incentives are, it's not guaranteed to actually do what you want it to do. But there is going to be some sort of value proposition for it, and I'm totally down to give feedback and work with you on that.
So again, Reflex Bonds are not an alternative to DAI. They are kind of meant to help DAI in a way as collateral.
Yeah, I meant with the MetaCoin itself, right?
Yeah, or MetaCoin. Yeah.
Awesome. Cool. I love to see that collaboration there. That's awesome to see live. So I'm going to throw it to Raphael to kind of do a kind of a wrap up of where folks can find more about Trust Token True USD. And I believe you have an announcement for us. Is that so?
Well, yeah, we've got a major product launch that's coming out soon, within the next couple of weeks, and it's going to be around being able to earn rewards directly on your True USD balance in your wallet, which we're pretty excited about. And it's going to be connecting to a bunch of both DeFi and CeFi opportunities. So that's something that we're going to be announcing pretty soon. It's a exciting product.
CeFi.
And if you want to learn more about Trust Token or True USD or any of our other stablecoins, you can go to trusttoken.com. And many people just don't realize how easy it is to use these products. You just sign up, you create an account, and then you can purchase and redeem any of these stablecoins. And it's a really easy way to move money into and out of crypto onto Binance or any other exchange you're trading or any of the DeFi products that I want to use.
Fantastic.
Last thing I mentioned is we're also hiring engineers globally. So if you're an engineer or you know any great engineers, let us know. We're having front end, back end, full stack, Solidity engineers, security engineers. So please check out our jobs postings if that's you.
Awesome. We'll link up everything that you mentioned, careers page, all the links and stuff like that. So yes, thank you so much for the wrap up. And then Evan, my man, do a quick kind of wrap up of Ampleforth and where folks can find out more about the project and some of the stuff you mentioned today.
Cool. Yeah. So Ampleforth is just it's a money, right? So essentially the way it works is it looks at the volume weighted price on a daily basis and automatically increases the quantity of coins you have in your wallet or decreases the quantity of coins you have in your wallet using a rules-based mechanism. Like I said, it's designed to be the closest thing we could create to Bitcoin while being significantly different, and it's meant to move differently and add diversity to the ecosystem. You can find resources on it at ampleforth.org. We are deeply rooted in kind of economic history and theory and macroeconomics, which may make the language a little bit different than what you're used to reading. We're also getting ready to launch a forum called Ample Talk. It'll be on ampletalk.org, where we'll kind of put together our perspective on things, right, which attempts to bridge what we've learned through the history of economics with what engineers have learned through their experiences with cryptocurrency and smart contract development. I think you'll find that in bridging the language gap between engineering and economics, a lot of insights can be gleaned and a lot of problems can be avoided, right? And so a lot of things that, for example, my academic advisors see going on in crypto are neither here nor there, and there are a few things that are very interesting, like Ample. And vice versa, the crypto sphere might be like, may see a lot of things going on that make a lot of sense to them, but view like a non-volatile coin like what Stefan is proposing, or an uncorrelated asset like what I'm proposing, as neither here nor there. So as recently as 4 or 5 months ago, like people might say, like, why would you want just an asset that's uncorrelated? I think Black Thursday proves the point. So the idea of hypercorrelation being a huge problem, that's something we were very, very attuned to because of research into economics. And it's something that suddenly people care about, but we've cared about it for a very long time. And that also is the case with things like the liquidity crisis that Maker faced. And so I think that before we get overexcited about promising things, let's just connect these two schools of thoughts, because I don't think there's enough cross-pollination. I think that there's a lot to learn. And so we'll be combining all those resources. We encourage everybody to participate. It's kind of like the place for money nerds in crypto, which is ironic. Like crypto has like cyberpunks, you've got builders, you've got math junkies and cryptographers. Oddly, there isn't really a place for the people who actually care about the economics of money to convene and discuss ideas in a non-hostile way. There's Bitcoin maximalists, but they can be very hostile. So ampletalk.org is the place for money nerds who are interested in crypto, and we'd like to bring that perspective to everything, and we'd like to kind of learn from you guys as well.
Fantastic. Well, I am very excited for the launch of Ample Talk. I'm very excited to hear more about Trust Token, and of course very excited to hear more about Reflex Bonds and the MetaCoin project. Guys, it's been my absolute pleasure to be with you, to moderate this panel, to be an ear, to listen to some of the amazing things you guys have said. I, for one, have my mind completely blown. I've learned a tremendous amount. And just to kind of wrap up and kind of tell folks some of the stuff that we went through, we spoke about what DeFi was. This was interesting because all of the folks in the room have like very different opinions on what DeFi is and how it should play out. So it was an amazing conversation. We also spoke about what stablecoins are, their roles in the ecosystem, and we actually challenged the word stablecoin with Evan's views on with his economic background and all of this stuff. So that was a very fascinating conversation. Then we talked about their role in DeFi, spoke about banks and monies. Then we spoke about True USD and Trust Token, MetaCoin, Reflex Bonds, Ample, some of the problems you guys are solving, how your systems work, and how folks can get involved. So it was my absolute pleasure to be a part of this panel. I very much appreciate you guys being here. Thank you so much, guys. I appreciate it.
Thank you.
Thank you.
Great.
Awesome. Fantastic. See you guys.